Hi and welcome back to the land of the tundra, where today we're going to continue our discussion on long-term debt. Our goal in this pencast is to demonstrate the accounting for a bond sold at par value or 100%. Another way to say that is the bond stated rate, and the indenture is equal to the market rate. So there will be no bond premium or discount. We'll start with the easy one. My bond indenture says it's a $10,000 bond. I'm going to use the same bond all the way through. Pays 10% semi-annually. You get the drill, and you know by now that it kicks out a cash flow stream that's 2 years long, where it pays interest every 6 months. That we borrow $10,000. We pay interest in the amount of $500 every 6 months, and at the end of that time, we pay off the bond. If this were a real bond, that would probably be 30 years long, 2 times a year, amortization schedule 60 lines. We're not doing it. So, here's our cash flow, and that's never going to change. Those are our facts for this bond. Now, I could make an amortization schedule and analyze this. Say that word, amortization schedule. But you know what? It wouldn't provide any useful information on a bond sold where it's sold at par. So I'm just going to make the journal entries based on our cash flow. I'm skipping the analytics and going right to journal entries. Don't do that too often. In this case, we're all right. Let's first record the fact we borrowed money. We'll get some cash, and we'll have a bonds payable in the amount of $10,000. That's our first journal entry. 6 months later, on 6/30, guess we should put dates on this. We issued this bond on 12/31/13. Let's get dates on it. See if I can do them right this time. On 6/30 and 12/31/13. I guess we're issuing it on 12/31/12, huh? Bite me. Just remember that for the past pencasts. And we have 6/30 payment, 12/31 payment, 6/30 payment, and a 12/31/14 payment. I hate it when they screw up dates. Just going to have to remember that for our first pencast. I think I have them off by a year. I can go back and change it. I'm doing that right now. I don't know if it'll work or not, but it's changed. We're back. I probably should have shut this off to do that. Ha! Oh well. Let's make our first interest payment. On 6/30/2013, we pay interest expense in the amount of $500, and it equals our cash payment. And our bond, we didn't sell at a premium or a discount, so we're just forking over the interest payments. On 12/31, you would make another interest payment, interest expense and cash, $500. And I'm not going to keep doing that because I think it'll make you crazy if I do. So you would make 2 more of these. Exact same entries right here. One on 6/30/2014 and one on 12/31/2014. And then the last entry, you would pay it off. So on 12/31/14, you would just say bonds payable debit 10,000. And credit cash, 10,000. So I just skipped these 2 payments because they're the same, and I went right for the last payment where we paid the bond off. How would this look on our balance sheet? Well, it wouldn't matter where you looked at it because there isn't a premium or discount changing the amounts. Under long-term debt, you would show a bonds payable in the amount of $10,000. And that wouldn't change because you're not amortizing a premium or a discount along the way. So that was a fast pencast to show you how to do the accounting for a bond when it's issued at par value. Thanks for joining me.